Okay. Good morning and good afternoon. I'm Jason with North Star Leasing, and welcome and thank you for attending the BBC. I'll be presenting today on financial guidance and lessons learned in time of a crisis. Feel free to ask questions via chat, and I will answer them at the end of the conversation or the end of the presentation. So just an overview on what we'll be discussing today, an introduction to the BBC, who North Star Leasing is, the growth that the craft breweries industry has seen, the difference between an SBA loan and third-party equipment financing, what we know is going on in the brewery industry, what we've learned during this crisis, comparison of some of the federal relief programs that are out there and being offered to all small businesses nationwide. I'd like to go over a case study from a North Star Leasing customer perspective of the before and after COVID-19. Also talk about some financial guidelines, what's changed in the industry, programs lenders are offering now to startups and established business, and preparing for the future. North Star Leasing has been financing equipment nationwide for over 40 years. We're in every single industry. We're located in Burlington, Vermont, and we help finance small to mid-sized businesses grow every single day. 30% of our portfolio is in the hospitality space, i.e. restaurants and craft beverage, breweries, distilleries, cideries, wineries, so we understand the industry. In 2019, we actually invested around $21 million into the industry, and that ranges anywhere from about $5,000 to $250,000. We've also partnered with multiple different lenders and banks nationwide, so we can reach excess of $1 million in equipment financing for those borrowers that need it. Again, we help startups and established businesses. The brewery industry is a perfect fit for us. So first off, we love craft breweries. Personally, when I go to the store, I'm always looking for that new brewery. I'm a person that thinks there's always room in the fridge for another good beer. There's 5 breweries within walking distance of our office, all of which we have helped in one way or another regarding the equipment financing. Statistic, Vermont is actually the second most, has the second most craft breweries per capita in the United States. We are dedicated to the craft beverage space. We started off by financing in the brewery industry. We started with kegs, keg washers, 3 to 5 barrel systems, tanks, fermenters, chillers, and canning lines. And then we've expanded into craft distilleries, cideries, wineries, kombucha, and coffee as well. We attend all the major craft beverage trade shows nationwide on an annual basis. We're here to provide some financial insight. We've helped hundreds of breweries open their doors and hundreds more expand to meet demand. 40% of our business is returning customers. We are not interested in one-off transactions. We are here to build long-lasting relationships. And that's why we built these strong partnerships with vendors and customers in this space. So craft breweries growth, enter 2020, we had a very solid foundation for the first 3 months of this year. And obviously the landscape has dramatically changed. Per the picture here from the Brewers Association, as you can see, amongst about 8,300 breweries, craft breweries nationwide, we saw pretty solid growth from 2015 to 2019, and about 1,000 new breweries starting up and opening up their doors every single year. North Star Leasing actually budgeted an increase of about 30% into the craft beverage space this year as well. Again, things have changed due to the pandemic, extended closures, tightened cash flow, social shifts, other economic variabilities. So the big question here now is openings and closing in 2020. What is that going to look like? On a positive side, we are still seeing opportunities every day. We are still funding deals every day nationwide in this space. People are still moving forward. They're purchasing equipment to prepare themselves for after this recovery. So one question we get quite a bit is, what's the difference between an SBA loan and then third-party equipment financing? The SBA loan is quite a long process. It could take anywhere from about 60 to 90 days. Third-party financing is a much shorter process, 24 to 48 hours. You should at least have an update or approval to move forward with your equipment purchase. SBA loans are a long-term loan. They're 10 to 20 years, whereas equipment financing goes from 1 to about 5 years. So again, it's a shorter-term financing option. The collateral is the equipment in both options. Regarding information required to get approvals, SBA loans they require a lot of information on your business, personal, where equipment financing is very minimal. It's mostly due to your personal credit score in a lot of standpoints, and also your business credit as well. SBAs require liens on all of your assets, so they're going to put a blanket lien on everything, wrap that all up to protect themselves. Where again, with the equipment financing, there's going to be no liens on additional assets. Again, that collateral is the asset. The equipment finance company actually owns the equipment till the borrower pays that off at the end of the term, and that's when that ownership is transferred to the real estate can be included with SBA loans, but not always. 9 times out of 10, when you're going after the 20-year note, that's when they're going to want to wrap in the real estate of the business as well, and possibly personal real estate too. Again, equipment financing does not wrap in any real estate. Personal guarantees are required for both options, but corp-only guarantees where a business would apply by itself cannot be guaranteed by an SBA loan, but it can be guaranteed through the equipment financing aspect. The good thing about the SBA loans, I mean, if you qualify and you get it, you're going to have some really aggressive rates. Again, this is a long-term note going out 10, 20 years. With equipment financing, the good thing here is that financiers are financing A, B, and C credits. Therefore, it doesn't really matter what your credit worthiness is. They're hoping to help you reach an approval and help it grow your business and invest in that equipment to help create additional revenue for your business that way too. And then the documentation process is a little intensive with the SBA, and it can be a little bit simpler with the equipment financing aspect. Another statistic that I was reading about recently is that the SBA actually decreased providing financing to startups in 2019 from 2018, whereas third-party equipment finance companies did increase because they understand the craft beverage and brewery markets. What we know about the craft brewery market. Before the pandemic, if you were starting up a brewery or you're established, your biggest margins were in your tap rooms and your tasting rooms. And then the product that you were selling to bars and restaurants were another great market or margin. And then your canned product was actually the smallest margins that you had. What we see now is a dramatic shift. Social distancing has adversely affected every single business in America. We have seen this. Breweries have been one of the hardest hit industries. Tap rooms and restaurants closing. Again, can productions are now really the only lifeline or the only sales that breweries are seeing coming in. So the ability to adjust and adapt to new norms and standards will make the difference between being successful and failing or having to close your doors in this industry. The canned products are paying the bills, but the profit is much smaller, and it's not allowing people to hold on to those employees that were once working in the tap rooms. So we wanted to, survive in the crisis. What we've learned, the good and the bad. The good news: breweries are essential businesses in America, so it means they can still operate. And what the bad news is, they've had to shift their offerings to only takeout, curbside, and delivery. Again, it's not really enough revenue, but it's paying the bills and it's keeping the doors open. If you had invested in canning and packaging equipment before, you should have the ability to weather this storm over the next 3, 6, 9, 12 months from now. Also, if you were, established business and you financed equipment or taken out other loans in the past, you should have some sort of business credit, which will be help you, get easier access to financing here in the future during these times of, wanting to expand or remodel or do some reconstruction work on your facility during the closures. The good news is the federal government did react, obviously not as quick as we would always hope, but they did do something. They had the CARES Act, it's a stimulus package, and this must help us bridge that gap. The government shut us down, but they also must figure out a way to keep our people employed. NSL, North Star Leasing, is a small business as well, so we're doing our best to weather this storm like everyone else. Some more good news. Beer sales actually increased for the first week of April. So people are still buying. People are still trying to support their craft breweries. So this was great news to hear. We wanted to shout that out as well to all of you that are getting into this industry. There's still opportunities. There's still potential for this industry. So here's a comparison of some of the federal relief programs, the Paycheck Protection Program, the disaster loan, and then some grant money. Really the one that everybody's talking about is the PPP. What this basically means is whatever your payroll structure was, with including benefits, compensation, salaries, everything for 12 months, the government asks you to do is take that average, divide it by 12 to get that payment for 1 month, times it by 2.5, and that's what the loan was going to be based off of. So obviously we're waiting now. We've heard that money had ran out as of last week, and it looks like the government's coming out with some more money as well to continue to help out in this matter too. So again, we wanted to showcase one of our current customers that are on our books. They're located in near Seattle, Washington. Where they're located is actually a very unique place. It's an island off of Seattle. It's a destination, really. You can only get there by ferry. They have about 10,000 residents. Again, location-driven, tourism-driven brewery location. They've been in business since 2017. North Star Leasing helped them finance a bottle filler and capping machine. The purchase of the bottler enabled them to sell in retail locations as well as wholesale distribution. They were actually brewing aged ale. They are brewing, aged ale for 6 to 8 months in whiskey casks to sell their product at a higher price point. And that bottling aged beer is more profitable, again, in the wholesale channels. They celebrated 1 year in January of opening up their door, and they saw great growth in their tap room. This is 40 to 50% higher. They signed a new lease on actually a second tap room, which they were hoping to open up this June 1st. They have about 3,500 gallons of beer fermenting. Life and business were good. So let's fast forward, again, after COVID, currently during COVID, they've opened a drive-through window. What they have called it, though, is actually a brew-through, which I really love. They've moved their whole entire menu actually to smaller portions, so it's now available for takeout only. They've invested in a POS system, again, to do that curbside, and they're selling gift cards online as well. They've been creative. They started a couple new products. They were able to introduce 2 new can lines. Again, we helped them with the bottling system that they had financed. And then they have moved their opening of the new tap room to just 1 month to July. So we're all wishing them the best to get that second one open. And obviously we'll do all we can to make sure that that's successful for them as well. They also started something, they went back to their roots 4 years ago when they had started, when the owner was actually making their beer on the back deck and selling to family and friends. They introduced a Beer of the Year subscription. This is a delivery service, a monthly subscription of their beer. and they're selling this at like $300, $650, $1,500 packages. And in the first 2 weeks, they actually signed up about 21 new subscriptions. So again, it's been just a new influx of revenue from them that they did not have before. And again, when their focus was totally on the tap room instead of adjusting like they did. Again, the breweries adapted very quickly nationwide, to keep the revenue coming in, to keep those doors open. They have also taken advantage of those programs by the Fed that we talked about a few slides earlier as well. So just some tips from the brewery. Relationships are built on good communication, and that's standard for no matter what industry you're in, right? They contacted every vendor and every lender to see who was in a position to just help with some grace, including rent. North Star Leasing, for one, actually offered a deferral payment of everybody on their books, April payments, just to help them as much as we could. Fellow restaurateurs, and then last step, a couple peers who were choosing, they had to close their door. They're helping them with their used equipment as well for actually their new tap room. And keep an eagle eye on your cash flow. Again, before COVID, during now, obviously, that's always been apparent. How much is coming in? How much is going out the door? Where can you shave on some expenses? Cash may be king, but buyers will be looking to hold on to their cash more than ever now, and financing is going to become more and more needed than ever before to make sure that people are holding on to that cash flow and can better manage their businesses or budget for their businesses. So what's really changing regarding underwriting guidelines? Startups have really always been a high-risk market. Again, doesn't really matter what industry you are, but now we're seeing that being even higher risk. Some underwriters are asking for higher down payments. This could be anywhere from 10% to 20%. They're looking for more skin in the game if they're going to be putting their money in the game as well. Again, the uncertainty of what's going on over the next 6, 9, 12 months is that unknown factor that's all on the tip of our tongues that nobody can really answer at this point. And again, I can't stress this enough. This is affecting everyone, and we're all really starting on new ground. So each application that comes in the door with an underwriter is going to be looked at with a very fine-tooth comb. Equipment restrictions, they want harder assets with really good secondary markets. Again, they're thinking about the risk and the what ifs going out there, but the equipment that is in the brewery industry are great assets to invest in. They're looking for obviously really good credit, but if you have great experience in this industry, this is going to be key. They want to know your past employment history. Why are you getting into this? Or are you just brewing some good beer in your garage, or were you working for a brewery in the past and now you're branching off on your own? These are things they're all going to want to understand. Why are you starting up and getting into this industry? Obviously, they want to make sure you're well capitalized. Again, they're going to want to see and make sure that you have the cash to make it through the next 6 months to a year. They're also going to want to see if there's any cross-corp guarantee opportunities. So what that means, if any owners of the startup brewery has an established business, construction, another restaurant, real estate, whatever it is, those financials of that other business will help tremendously in getting your start off the ground and obviously getting the approval that is best for you. Again, we're always trying to meet that monthly payment that meets your budget and cash flow. We want to make sure you're successful. Established breweries or established companies and breweries, I mean, really nothing has changed in the finance industry on what they're looking for. Maybe it was 3+ years before, now it's 5, but it's still, really good credits, really good business credit is for sure. Again, they want to see if you've had past debts out there and how you're managing that. And again, the more guarantors that you have, the better it is. I always say the more information, the easier it is for us to come to an approval sooner than later for you. So, we want you to be prepared when you're applying, whether that's an SBA or through third-party equipment financing. They might not ask for all this information, but these are going to be what they're going to be asking for, what they're going to be thinking about, and what they could ask for. If you're a startup, it's not going to be last 2 years personal and business. It's going to be last 2 years personal tax returns. They're going to want to see last 3 months to 6 months of personal and business tax returns. They'll want to see a current balance sheet if you're established and a current P&L. If you're starting up, they're going to want to see your business plan and most importantly, your financial projections. What kind of research have you done, for your location? How profitable do you think you're going to be, over the first 12 months, 2 years, 3 years, out to 5 years? We understand that changes, but we want to, see where your head's at, how you're thinking about this. Maybe a debt schedule. They want to see if you have any contracts lined up, maybe with distributors or wholesalers or restaurants, obviously, when they start to open back up. If you have other employment, and again, you're working somewhere else, and then you're also starting a brewery on the side, they're going to want to see his pay stub, maybe potentially a resume. Again, that all goes back to industry experience and what they're looking for. So some things that we've seen change. Some lenders out there have actually stopped offering equipment financing for the next 90 days just due to the uncertainty. They've also stopped financing to very industry specific, i.e. restaurants, hospitality, stuff like that, the people that are not open right now or can't open their doors due to the pandemic. With North Star Leasing and other lenders like us, we realize that there are still opportunities out there, like I said before, where we're still seeing opportunities come in the door every single day, and we're still financing them. Because as a very flexible lender, we're able to see those opportunities and our way through them to make an educated risk decision. What are lenders that are still open and offering for financing to help people, again, open their doors or the established to expand? First, they're offering some like step payments. What a step payment is when you start your loan or your lease, they would offer smaller monthly payments while you're still opening or waiting for the equipment, so you can manage that cash flow until that equipment arrives and starts generating revenue for your business. And then at that time that the equipment arrives, that's when the increase in the monthly payment would happen, because obviously that equipment is starting to go to work for you. They're also offering deferred payments for well-qualified customers. This could be anywhere from 30, 60 to 90 days. They're also offering potentially no money down as well to, again, get that equipment you need now instead of later. And then those for you that are not familiar with leaseback options, what a leaseback is when you own a piece of equipment or hard collateral outright, and you have the ability to sell that to the lender. The lender will purchase that equipment from you, give you the money back at the value of it at the present, and then they will lease that equipment back to you. Again, at the end of the term that you choose, you would own that equipment outright again. So again, it puts some money back into your hand as working capital to allocate towards other parts of your business. So again, if you're a startup and right off the bat, you had a bunch of money and you invested that all into the equipment right away, and now you need that cash back to, again, allocate towards other parts of your business, you could potentially have that ability to get that money back. So preparing for the future. Customer and vendor relationships with lenders are paramount. What do I mean by this? We succeed when you succeed. We are all in this together. We want to be as open as possible. We understand that outside money is there to free up the cash flow. 9 times out of 10, when a person is going to purchase equipment, the underlying issue is cash flow, and that's going to decide if they're going to buy right now what they can afford or what they can truly need. And financing will help you get truly what you need by getting, instead of paying for that in a one lump sum, it'll allow you to pay monthly payments while that equipment generates revenue for itself. Again, there's less cash down, so you can save that limited cash for other areas of your business, like expansion, improvements, or marketing, or hiring more employees. And also financing will allow you to customize your terms, like we talked about before, step payments, seasonal payments, quarterly payments, annual payments. Again, we want to customize it to match your cash flow and your seasonal income fluctuations. So I'm going to open it up now to a couple questions. So I have a question come in. Do you have some deals in Canada customers or just contact? So we don't, us North Star Leasing personally, we don't finance directly in Canada, but we do have partners that we utilize in Canada to help with that, and they pretty much provide the same options as we do, lease to own with a dollar buyout equipment option at the end, 1 to 5 year terms. Again, the equipment is the collateral. So there are options for that as well. Again, startups and established businesses for that. We are scheduling one-on-ones afterwards as well. If you'd like to go in more in depth, happy to do that. So let's see here. SBA loans, not much mentioned about leasing versus buying. So, versus buying, if you have the cash in hand and you have the other cash to be able to extend, then you got to do what's right for you and your business, right? But leasing to own is meant for you to be able to hold on to that money so you can allocate it towards other parts of your business, allow that equipment to generate revenue for itself over the life of the lease, therefore it will actually pay for itself instead of outlaying all that cash out in the beginning. So that's one of the positives versus it when it comes down to it. Also, a lot of lease agreements talk to the lender. You should be able to offer no payment or no penalty for early payment regarding that as well. Another question I had here is when should a startup actually apply for equipment financing? I always suggest as soon as when you've secured your location. Again, the underwriter is going to want to know where that location is, learn a little bit about it, the environment. Also, again, they want to make sure that if they're financing this equipment for you, as soon as they get it, they want to make sure that it's going to go to work for you and start generating revenue to pay back to pay back the lease. So for a startup, do you foresee things like canning, bottling, and or food options to go being more of a standard in business plans for flexibility than taproom? I would say yes. I mean, from our case study alone, I would encourage people to put in drive-up windows, right? If they have the ability and stuff like that, there's going to be a new norm. It's going to be a while before people are comfortable going back to a restaurant or sitting next to somebody at a bar or something like that. I mean, we'll get there. It's going to take time. So I would say that to remain flexible now and after is going to be key, yes. Another question I had down here. So what are some ranges of rates? So again, for equipment financing, again, it's an A, B, and C market. Rates, it's a big spectrum here. Everybody knows their credit worthiness. But if you're the cream of the crop, you have really good, excellent credit, you could see rates, as low as 5 to 10%. Then, your B credits are anywhere from about 10 to 15. Your C credits are anywhere from about 15 to 20%. Bottom line, if the lender is able to come to that approval and you can budget that monthly payment wherever you are to meet your cash flow, then it's going to be better than giving up all that cash right at the beginning, especially when you're starting up. And with the ability to pay off early with no penalty, these are options for everybody. So payments are calculated through equipment financing, time in business, credit score, the equipment as collateral, again, your industry experience. It's a whole number of things that meet that pie for the underwriter to make that decision. But again, the more established you are, the better the credit you are, the better the rates you're going to get. In the end, it's going to be, we're all going through this every day, hour by hour, day by day, week by week right now, and it's forever changing landscape in all reality. What is the estimated approval time for a loan application? So again, if you're going after an SBA, it could be anywhere from 60 to 90 days. With everything that's going on, I'm guessing it's actually going to be a little bit longer now. Everybody trying to get that PPP money and other disaster relief loans. With equipment financing, it's really kind of business as usual because that equipment is the collateral, and we're seeing approvals anywhere 24 to 48 hours. Now, if you have to provide additional financials or additional information, that's when the process could take a little bit longer. Okay. A couple other questions here. Will lenders finance from multiple different vendors at the same time? Yes, you can bundle that purchase so you only have one monthly payment, and the lender will actually pay all the vendors separately. So again, allowing you to handle that and get all the equipment you need at once instead of just getting all the equipment that you think you can afford at this time. Will lenders actually be financing used equipment? Only if it's coming from a vendor and not from a private seller. Especially with all the uncertainty going on here, there's no guarantee of you actually getting your equipment if it's from that private seller. Lenders like working with trusted vendors because they're investing in you, they're investing in the equipment, and they want to make sure that you're going to get that equipment when we send the money over to that vendor. An option here, if there is a used equipment out there, is that lease back, where you would potentially pay for that used equipment out in cash. Now you own it outright, and then potentially have the ability to sell it back to the lender to get that money back in the hands and do the lease agreement that way as well. Again, it's just limiting risk on all parties' ends. I want to thank you all for attending the first VBC in our presentation today. I hope you got something out of it. I look forward to the one-on-one sessions afterwards and anything you need. My contact information is down there. Feel free to shoot me an email with any questions that you have. There are no dumb questions in my mind. We're all going through this together. That is my direct phone number as well. Hopefully next year I'll see you all at the Craft Brewers Conference. I appreciate your time, and I hope you have a great day. Stay safe.